what happens when Australian expats return home holding shares under the deemed acquisition rules. Now in this example, we have an Australian expat who moved overseas and became a non-resident for tax purposes on the 1st of July 2025. They subsequently purchased 100 shares at $10 per share on the 1st of January 2026. Now, hypothetically, if they moved back home 2 years later, at which point they became a resident for tax purposes again on the 1st of January 2028, and the shares were then valued at $20 per share. Now, what happens with deemed acquisition is this person is deemed to have acquired those shares at $20 per share for capital gains tax purposes with the ATO. So $20 per share becomes the new cost basis for those shares, not $10 per share. Now, if that person then decided to sell those shares 2 years later on the 1st of January 2030, and the share price is now $25 per share, they're only going to be subject to capital gains tax on the capital gain from $20 to $25, which is $5 per share or $500 on 100 shares. Now, how the 50% CGT discount works here is because in this instance, this person has held those shares for more than 12 months, from 1 Jan 2028 to 1 Jan 2030, they will be afforded the 50% discount, so that capital gain becomes $250. Now, this is how deemed acquisition works for Australian expats that are returning home to Australia.